Welcome to Markets Now. I'm Michelle Rook with Mike Miner, Professional Ag Marketing. We are being mostly lower in the livestock futures today, but the grain trade mixed. And Mike, corn and wheat did start off lower on the morning, especially wheat with that China cancellation and more SRW wheat. But we did have a nice bounce here. We priced all that bad news in.
Yeah, so right at 8:30, the wheat market really fell out of bed there. We saw that cancelization really hit the markets after that open, and we've been able to recover quite well through the end of the day. And in those wheat markets, closing some of those above double digits through those complexes, and we've still got a decent chunk to go, probably with cancelizations. We've got about 30 million bushels there to China that we could still have open bushels that could be canceled. So we've got about half of them kind of out of the way, it looks like. Export shipments are still running about on pace for what we need at this point. So we'll see if they continue to cancel some more or not. But at this point, seeing what the USDA did on Friday, lowering exports for the United States on wheat, they've already started to adjust some. And really, this wheat market getting to some really low levels, we've seen some really nice recovery, and it just seems like that market wants to get some shorts covered ahead of the growing season, especially with a few areas a little bit too dry here that are important for wheat production.
So corn came back with the wheat market, but corn on its own has been looking much better from a technical standpoint now that we're above that 20-day moving average. Can we keep going?
Yeah, and up until this point, really, the corn market's been pushed pretty hard by the wheat market. And at this point, we haven't seen a ton of incredibly friendly news or real negative news recently on corn. I mean, when you really look at it from an ending stocks perspective, it's a pretty burdensome situation once you start to look at the outlook numbers for this next year's crop and really further out. But we did start to hear things like record net short position on corn a couple weeks ago, and we're heading into a growing season, and that's pretty bold for them to make a stance like that. So we have been able to cover some shorts up, kind of come off that position a little bit, build some momentum, get on top of that 20-day moving average. Now we're approaching this top end of the Bollinger Band. We may see some resistance here, but really at this point, the market's just preparing itself for some more friendly, bullish news out of this corn market that we have yet to see. But we are approaching that time of the year where we do start to see something, Michelle.
Yeah. So the soybean setback here, we had a pretty nice run or rally last week. Still above the 20-day moving average there, but do you get the sense that the funds are done pushing the record short position that they've accumulated now or not?
Well, the soybeans, as of Friday's report in the commitment of traders, they were holding a record net short position on Tuesday this last week at 172,000 contracts. Now, we have had a pretty decent rally recently on the soybeans that maybe missed out on some of that. So we are looking at 48-cent rally or so off this contract, the recent lows on the soybean market. So we have covered a little bit so far, and we've started to see some support there. Brazil, in their current situation, is starting to matter a little bit less out of their news cycle. We'll hear what Coneb says here tomorrow and some of their reports, but seeing numbers continue to just slightly fade away in the USDA's report for their production. It isn't quite as big of a deal as what it would have been a month ago. So we'll see what they say tomorrow on that, if they continue to lower it down or not, or if they've kind of held in the low 150s, high 140s for production out of Brazil. But I'm very curious to see how the market's going to react as we go into this growing season and start to really talk about what position the United States is in for production going forward.
Yeah. And as far as the Coneb number, I mean, where do you think we have to be? Is it sub 145 or what before the market would react positively? Because probably a lot of this is worked in already, isn't it?
Yeah, I mean, anything below 150 is going to start getting a little bit more friendly. It's just got to be enough to get the USDA to pull off their mid 150s number. And they've been really slow to adjust. So as long as we continue to see Coneb continue to take a little bit off every time, kind of be south of that 150 number, we could still see a little bit more support. But when you start to combine Brazil's number with Argentina, I mean, they still have a plenty big crop out there, it looks like at this point.
Yeah, and unless we start seeing some big China buying of US soybeans or otherwise, it's going to be tough to continue to feed the bull there.
Hmm.
When you look at the overall short position of the funds in all of the grain market, Mike, unusual for them to be this short this time of year. I mean, they don't have a lot of risk premium put in for what you said. If we have any problems with our growing season or planting season, right?
Yeah, so if you look back at history with where ending stocks to use ratio is right now versus history of prices, in that January report with our fundamentals, that chart would have suggested that March corn futures be somewhere around $3.50. Now, I mean, we did get into the threes. We took a lot of premium off that March contract. And really, that was the first one. I mean, we saw December come off the board near 4.5, and September came off around just higher than that as well. So March was the one that really corrected itself, it seemed like. And once you start getting around that $4 area, there's not a ton of weather premium left in it, especially if you start to consider inflation into this category. So when I look at the position that we're currently sitting in on funds, and especially ahead of a growing season, the last time we saw them carry in record net short positions like this was before 2019's growing season, which you and I remember it both. That year went very uniquely after the springtime time frame. So they kind of lost on the way up and down after they covered their shorts and went long. So I'm curious to see if they're quick to pull off those shorts this time, or if they're really going to go for it and just continue to hold a short position through most of the growing season.
Yeah. 19 was the year we had all the prevent plant, I think, wasn't it?
Yep, we were right in the
Yeah.
heart of it here in Minnesota and South Dakota.
Yeah, no doubt. Okay. Cattle market on Friday, we scored a reversal in the live cattle futures here. Obviously, it was disappointing when you had higher cash and cutout values. Are we just going to continue to consolidate, or is there more risk in this market? Are you concerned about it?
Well, so far here, box beef values have been holding quite well. Slaughter's been running a little bit lower, so box beef values have been able to hold higher with decent demand yet. Cash prices might not advance as high as what some people would like them to with the lower slaughter levels. Cattle prices in the South still up a couple bucks last week, and in the North, maybe a little bit more than that. But we'll see what cash does here in retaliation to a little bit lower volumes getting killed here on the cattle front. But as long as we see decent demand and a decent demand picture going forward, we should still be in the clear on this cattle market as long as we can keep momentum in an upward direction, because that chart is incredibly consolidating here towards that 20-day moving average, and it's going to want to break out at some point.
Yeah, no doubt. What about the hog market? Are we just consolidating there too, you think?
A little bit. I think the hog market might be, cutout was slightly higher again this morning with gains throughout most of the cuts. You're looking at a recent cash pattern that's been stronger to start off the week, and that's probably going to carry over into this week again as well. But when I look at more fundamentals with, cash isoine prices being a little bit higher than they were last year, I mean, you're looking more like $57 at this point versus $51.50 last year at this time. So still some optimism with really nice margins into the summer time frame, and a little bit more exciting for hog producers to look forward to from here on out. I know that we've still been operating in a poor margin environment basically up until this point, but looking further out, there are some margin opportunities through this May through October timeframe that producers can get a little bit more excited about. And fundamentally, we're still sitting good. Yeah, I don't have anything against where we're at fundamentally, but it'll be interesting to see where we're at from this time of the year, and what market direction looks like, because this April contract can really go one way or another on a guy.
We have a lot of optimism built in those summer months, though, Mike. Do you think that is warranted, huh?
At this point, it sure seems like it with fundamentals, but it's a summer market, so sometimes they don't seem to take care of themselves, especially when you're over $100. But at this point, if you're looking at a fund position of over 65,000 contracts long yet, I mean, record in around that 97,000 contracts, we could still pile on a few more longs into this, and also from a producer standpoint, how many hedgers are still going to be selling it above this mark? We might not have a ton of seller pressure holding it back as we start to run higher. So I am very curious about what kind of upside this has, but to the extent of just what we've seen here the last couple of years, a lot of margin opportunities out there that should probably get looked at hard.
You bet. Good advice. Thanks for joining us, Mike Viner with Professional Ag Marketing. That's Markets Now.